Good evening and welcome to a brand new show of Markets Tomorrow. I'm Nikunj Dalmaya.
Hi everyone, I'm Avan Dabash. Well, let's start off then by telling you about our three experts also who will be joining in on the show today. So we'll get in Anup Bagchi, MD of ICICI Securities, Sandeep Wagle, as well as Prashasta Sheth, who will be joining us. Prashasta, going to come to you first. I mean, at one point of time, we were talking about piercing crucial levels of 63 plus on the index. But do you also concur with Nikunj that this kind of a consolidation is now inevitable?
See, if you ask me, I think for me, the case for markets moving significantly up from where we are at this point of time is very, very difficult, according to me. Yes, the global liquidity can drive the markets higher, but the ability of markets to go higher and sustain there, according to me, is very, very difficult. I think where we are in terms of both economic recovery and the kind of interest rate environment that we are seeing, I would find it very, very difficult to believe that there will be a significant acceleration in earnings over the next 2 to 4 quarters. And if that is the case, and even though the green shoots are available and earnings have been okay, for me to justify a valuations of more than 15 times 1 year forward is very, very difficult. And to that extent, I would think that markets at these levels are fairly priced to slightly expensive, and I would think that markets should kind of, over the course of the next 3-6 months, depending on how the tapering discussion goes, should see a huge amount of volatility. And once the tapering becomes clearer, you might see even some downside from where we are at this point of time.
Do you think, Prashasta, tapering fear is more like a storm in a teacup? Because the world this time around is prepared for the tapering event.
I think it's yes and no. I think it's something that people are more prepared than what they were at that, in July, August when it initially happened. Having said that, I think you have seen a gush of liquidity coming back to the markets when it was clear that tapering is not likely to happen. So if you wouldn't have seen any significant inflows to the markets once the tapering was off, I would have think that markets would not react negatively once the tapering announcement actually happens. But given the kind of liquidity that we have seen over the last 1 month to 2 months on hope and confirmation that tapering is not going to happen in the next 1.5 months, I would presume that once the tapering actually happens, you would definitely see some amount of outflows happening. And if that happens, I think even though we will be better prepared than what we were last time, we will still see a downfall from the current levels.
Sandeep, let's get in your view on the charts. Do you think that, as of now, you would continue with your long bias on the index and believe that the undercurrent remains strong and that this kind of a move that we saw was just a one-off consolidation?
Avan, as a trader, I would certainly not be very happy with what has happened in the last 1 hour. So, as a trader, we have cut off all our longs, because when you trade in FNO, you cannot have such long stop losses. But as a position trader or as an investor, I still feel there is nothing to worry about. We will test 63.50. Now, yes, such kind of moves, when they happen, that time taken for that could be larger, in the sense that first we may come down to 6,000. We may spend some time between 6,000 and 6,200. And over the next month or few months, we may go to 63.50 or maybe even higher than that. That long-term view has not changed. But as a trader, the view has certainly changed. I am looking at, as an FNO trader, downside at 6,5980. So I see Nifty 100 points in the immediate future, where I would be willing to go short for a 50-point stop loss on the Nifty and trade for a 100 points target on the Nifty. So as a trader, some more downside, but as an investor or as a position trader with a few weeks to a few months time horizon, I think till 59.50 is not taken out, we don't need to worry about it.
Anup, beside state elections outcome, which obviously is the next big political trigger, do you think somewhere RBI policy will also give some kind of a directional sense to the bulls?
No, equity standpoint, I don't think it's going to be a big event. In fact, just before the last time when the hike came, we had predicted and we had said that, it's a small flip. But the basic issue about bank is what is our view on NPS and stress on the banking system, because it's balance sheet which is more important in banking than the profit and loss account. And from that perspective, NPA issue is still there, so it's not off. Although the credit that is coming in and the banks underwriting credit is becoming, better. So, for example, there are no bad credits being taken up. The banks are very cautious. In fact, they are not lending that much. And we hope that, if the NPA pressures come down, I think banks will see a good run. And we have seen a lot of cleanup happening. But banking stress is something that we have to worry about. Not so much of interest rate, I would say, from the banking sector. Although, it's more topical.
Anup, in the given scenario wherein it's 50-50 buy-sell inflows and outflows, where is money being allocated sectorally or stock-wise?
No, sectorally, I think, money has started to go back into banking. And, some money we are also seeing in, PSU banks. Because PSU banks, 2-3 months back had been completely written off. But I think large PSU banks is seeing some flows there. Money is going out of FMCG. And people are seeing that the valuations are expensive, consumption cycle may taper a bit. And so money is going out of that. Money is coming back into IT because I think, the results are strong and I think, US and Europe both are doing reasonably well. So money is also going into IT. Money is going into this. I would say that disappointment has been, cement because there was some money in cement and the results have not been that good. So money is a little bit going out there as well. Pharma, it is there, it's neutral. It's not coming in, but it's not going out. So I would say these are the sort of pluses and minuses among the large sectors.
Sandeep, let's get in your view then on some of the banking stocks and the way the Bank Nifty future just absolutely succumbed to selling pressure by the end of the day.
Well, Aman, I would say that the banking space is as weak as the Nifty. I won't say that it has fallen more than the Nifty. It is in line with the Nifty. So in that sense, yes, if I'm looking at 80 to 100 point downside in the Nifty, 200, 250, 300 point downside in the bank Nifty can't be ruled out. So I would talk of a 10,700, 10,750 level on the Bank Nifty, and probably maybe 100 points up would be the right level to sell it. So in that sense, both look the same to me, as equally weak is what I would say.
Nope, it's not been a complete washout quarter for some of the large cap PSU banks. Is there merit in revisiting PSU banks selectively? Because at least names like State Bank of India, PNB, you can throw in a BOB, Can Bank, they offer some value.
No, I think there has been a very, very, very clear divergence. Banks who have reported better than expected asset quality, there it has moved up, and banks which have reported less than expected asset quality, they have been sold. So, there is a very clear divergence, and I think at this point of time, even on the private sector banks actually, I think the street was expecting that stress will show up more and the profit growth will be lesser. So there has been a positive surprise there. In some large banks, there has been a positive surprise on the asset side. And in some large banks, PSU banks, there has been a negative surprise as well. So I think markets are very, very clearly focusing only on one variable there, and that is the asset quality. And banking balance sheets are very complex balance sheets. It's very difficult to make out what is the asset quality just from the balance sheet. Of course, you can do some call sectoral exposure, etc. But it's very difficult to make out. So people are hanging on to every word. People are hanging on to body language. People are hanging on to exposures of particular banks. But clearly it is asset quality, which is why I was saying just some time back, it's not interest rate hike that they are looking at in the banks. Of course, there will be some sentimental and topical up move if something happens positively on the interest.
Prashasta, what did you make of all of the humdrum in the sugar basket? Of course, the deadlock now continues, and perhaps we might get something conclusive only within the next 8 to 10 days. What does this mean for the sector?
See, for me, it's a sector that you need to trade on news. I don't think I can make a fundamental case for being invested in the sector, because things change and things change in a hurry, and I don't see these companies making money on a sustained basis for the next 2, 3, 5 years. So I think it's a sector that one needs to trade. One needs to look for opportunities when the news flow is positive and just trade. And for investor, I think it's a sector which one should just avoid. I think there's no point in trying to fathom and understand and try and speculate what's going to happen with these companies 1 year, 2 year, 3 year down the line, because you just can't even guess the earnings 1 quarter down the line. So as an investor, you just avoid it. As a trader, you just wait for the news and trade.
Rasta, but if you're buying sugar stocks, you're buying them at option value now. Balrampur at 48, Bajaj Hindustan less than 20 rupees, Mavana Sugar at about 9 rupees. Whatever could go wrong for the sugar sector has already gone wrong, and now things incrementally could only improve.
I agree. If you have that approach, I think you will get, at least once in 6 years a sugar cycle which is positive, and one, phase in which these companies will do well. I think the other thing that you need to look for at this sector is essentially decrease in interest rates. That's going to benefit the sector immensely, because the balance sheet for a lot of these companies are very, very highly stretched. So if you want to take a call on a small part of your portfolio, you want to take it as a punt or something where you are, which is extremely available, extremely cheap, and once the cycle turns, you could make 3x, 5x returns, and you want to allocate a 5% of your portfolio into that, I think one can do that. But you can't take aggressive positions or, take, a decent chunk of your portfolio into, something like a sugar sector. But yes, you can take an approach saying that, things are available at a very, very cheap valuations. Let me put a punt. If it plays out, I can make a multi-bagger returns.
Sandeep, want your opinion on two stocks which showed very divergent moves today. First off, a Jubilant Foodworks succumbing to selling pressure today after quite a while, and a Just Dial which was very resilient. Okay, we'll just take it to Sandeep in a short while from now. But Prashasta, what's your view on the overall consumption theme, and do you perhaps think that some of the positives that we've seen are already factored in?
For me, both the stocks are sell, frankly. For Just Dial, I thought at 700 is expensive and the stock is at 1400. So, it depends on what's happening globally, what valuation Twitter is trading at, and what valuation people are willing to give to internet-based companies. And that's essentially flowing into Indian stories as well. So the kind of move that you've seen in Just Dial and to an extent in Info Edge is clearly indicative of the fact on whatever valuation people are willing to give these companies. Now, whether 86 times earnings is the right number or 200 times earnings is the right number, I don't know. For me, at 50 times, the stock is expensive, but things continue to move on. So I think it's a bet that individuals have to take as an investor on whether they are essentially willing to look beyond profits and essentially look at other factors which Street is focusing on. On the Jubilant, obviously, I think there's a clear case of slowdown in terms of discretionary spending, and we have seen it across categories, and I would think that same-store sales of Jubilant will continue to slow down. And again, at these valuations, I find the stock expensive. So for me, both the stocks are a sell if I want, though I don't, own any of them.
Let's identify some of the stocks that you should keep on your radar. We'll start off by going across to our research team. Poonam's here with what the dealing rooms are advising. Poonam.
Well, Avan, we have two stocks. KSK Energy Ventures, a buy on that. Wardha Coal Quality Improvement is likely to benefit the company via reduced fuel cost, as well as the company is raising syndicated debt in order to reduce the cost of interest. Besides that, there is analysts do say that this stock could be a multi-bagger if the bids from the UP government do get accepted, and this stock is again seeing a lot of institutional interest. The stock is up nearly 13% in the last 1 month, so a buy on that. Besides that, it's a buy on Cadila Healthcare, wherein the margins have bottomed out, so expect future margin expansion. Expect new drug approvals from the key markets, and also this company has not performed very well in the recent pharma rally, as well as there are no concerns from the US FDA front. So buy on that. And Motilal Oswal also has a buy with a target price of rupees 806. The stock is up nearly 9% in the last 1 month.
Sandeep Aglia, what are your top ideas for... Okay, Sandeep's not there. Prashasta, let's nail it down to what are your top ideas? Where are you allocating capital? Do you think markets has already seen some degree of run-up, or are you still allocating capital at the current juncture?
So we are holding some amount of cash in the portfolios, and incrementally I think at these levels I'll still more comfortable in putting money in select pharma names and select FMCG names like ITC and United Spirits, rather than essentially going and buying aggressive names. So we are still allocating defenses. We are still very, very defensive in our portfolios. And I think, as I see it, I think till we see a clear move in terms of interest rates, we will continue to be defensive in our portfolios. So the defensive bias maintains. is maintained. We have incrementally allocated some more money to IT, but IT, pharma, FMCG, and to some extent banks at attractive valuations are where we are allocating money.
When you say defenses, Prashasta, you also have some of the mid-cap pharma stocks which have exhibited pretty strong movements. Is there anything that you like from this basket?
So we have a decent holding in Torrent Pharma. I think the valuations there are still reasonable. I think the stock hasn't seen a kind of vertical move that a lot of other mid-cap pharmas have seen. Valuations at 50 times, earnings likely to grow, 20% compounded over the next 3 years or so. So that's one stock that we like. I think the other stock we are still okay to hold is Biocon, where we believe, I think that there's a significant option value in terms of biosimilars, generics plays if it happens. If, the stock is available at reasonable valuations, and if biosimilar stories play out, I think Reddy's along with Biocon would be the two big beneficiaries. So we see a decent amount of option value for biosimilar story, which is not priced in Biocon stock. So those are the two names on the mid-cap pharma that we hold.
Anup, after the recent run-up, where are you comfortable in allocating capital? What are you advising your clients to do in this kind of a market environment?
On the mid-cap, it will be, I would say, Havells is good, Shree Cement is good. On the large cap, if you look at from risk-reward perspective, I think Reliance still looks good because, downside is protected, upside may come. ITC is a bit of a risky thing, but, on the consumption space, if you have to have allocation in FMCG, I think that's a best stock to have. Cipla looks good. Cipla looks good on the large cap. And if you want to take a call on the cement, on infrastructure essentially, I think one must have, because if the cycle turns, it will be good. Ultratech will be a good buy at this level.